Welcome, everyone, to this explainer. Right off the bat, we're unpacking some absolutely fascinating research on Aeroflex Industries Ltd. We're going to take a really structured, deeply educational look at a company that is quite literally in the middle of a massive technological pivot. We'll examine the undeniable strengths of their business model, but, and this is crucial, we are also going to face the hard truth about their current market price.
But before we get ahead of ourselves, I need to read our standard disclaimer. Welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
Okay, let's dive into our roadmap for today. We're starting with the Aeroflex business model, followed by their highly anticipated AI data center pivot. Then we'll check their financial health, look out for any red flags, navigate the valuation trap, and finally, deliver our investment verdict. Section 1. The Aeroflex business model, a niche OEM manufacturer.
Now, you might be thinking Aeroflex is some brand new startup, right? Well, actually, scratch that. They have a proven 26-year track record as a high-quality manufacturer of environment-friendly, metallic, flexible flow solution products. It's a mouthful, I know. And their global footprint absolutely reflects that experience. The Americas make up 42% of their revenue, and Europe brings in another 21%, reaching over 90 countries worldwide. But definitely don't ignore that 31% slice representing India. Their domestic revenue is actually accelerating rapidly. We're talking up 50% year over year, which just beautifully diversifies their income streams.
So what does this all mean? The absolute crucial point here is understanding their moat. Like, why can't someone else just come in and easily copy them? Well, Aeroflex makes high-specification, safety-critical stainless steel hoses for heavy-duty industries like oil, gas, and aerospace. Think about it this way. An industrial hose might only make up, say, 0.1 to 0.5% of a total project's cost, but it represents 100% of the failure cost if that hose bursts. Because the stakes are literally that high, customers demand certified, proven suppliers. Qualification for a new supplier, that takes 6 to 12 months. Once Aeroflex is in, they are locked in. Add their massive catalog of nearly 3,000 specialized SKUs, an NABL-accredited R&D lab, and a totally debt-free balance sheet post-IPO, and man, you have a highly resilient business. Section 2. The AI data center pivot. Liquid cooling skids. So here's the million-dollar question. How does a steady, traditional stainless steel hose company suddenly step into the absolute hottest tech trend on the planet? Well, the answer lies in thermodynamics. Next-generation AI servers generate an unbelievable amount of heat. Traditional air cooling, yeah, that just doesn't cut it anymore. They desperately require liquid cooling. And Aeroflex has brilliantly stepped up by manufacturing high-value liquid cooling skid assemblies, designed specifically for these modern AI data centers. And let me tell you, they are capitalizing on this fast. In fiscal year 2026, they sold 617 of these cooling skids. But look at this capacity scale-up. They aggressively pushed capacity to 6,000 units by March 2026, and they are targeting a massive 15,000 unit capacity by June 2026. Plus, they secured an exclusive supply agreement in India with an unnamed US tech client. If this scales according to plan, this pivot is absolutely transformational for both their revenue and their margins. Section 3. Financial health and growth. Operational leverage. So how is this core strength and this exciting new AI pivot actually reflecting in the bank? 2 words: operational leverage. Over the last 5 years, Aeroflex has grown its revenue at a compound annual growth rate of 25%. Even better, their profit after tax has compounded at a staggering 56%. Their EBITDA margins have expanded from around 15% 5 years ago to a record 22.6% today. This shows real pricing power and massive efficiency as they scale up. Let's just briefly run through the hard numbers for FY26. Revenue hit 442 crore rupees, and profit after tax landed at 56 crore. Their return on capital employed is a very healthy 23%. And for those of you who love safety metrics, like I do, their Altman Z-score, which basically measures the likelihood of bankruptcy, is greater than 10. Just to put that into perspective, anything above 3 is considered the safe zone, so bankruptcy risk here is virtually non-existent. Section 4. Red flags to watch. Debtor days and cash flow. But hey, stress-free investing means we really have to look under the hood for potential problems. No company is perfect, right? And we need to be completely clear about the risks.
The first number to watch is 113 days. This represents their debtor days. In simple terms, while revenue is growing nicely at 17%, customers are progressively taking longer and longer to pay them. 5 years ago, it took 72 days to get paid. Now it takes 113. This is pretty common in export markets, sure, but it ties up cash and is honestly the single most important efficiency concern we found in the source material.
The second number we need to look at is negative 5 crore rupees. This is their free cash flow for FY26. Now I know negative free cash flow sounds super scary at first glance, but context is literally everything here. They're spending heavily right now, around 60 crore in capital expenditure, to build that massive 15,000 unit skid capacity for the data centers we just talked about. Basically, they're deliberately taking on negative cash flow today to capture that high margin growth tomorrow. Section 5. The Valuation Trap. Pricing in Perfection.
You know, the golden rule of investing is that a fantastic company can still be a terrible investment if you pay the wrong price. And this number right here is the elephant in the room, 93 times. That is Aeroflex's trailing price-to-earnings ratio based on a 385 rupee share price. To put that into perspective, the median PE for small-cap capital goods companies is only around 35 to 45 times. So, at 93x, the market is already pricing in a flawless, absolute best-case execution of their AI data center pivot. There's almost no margin for error. Let's map out the scenarios based on the research. If they execute perfectly, this is the bull case. The target is 570 rupees, which represents a 48% upside. But if they face any delays in scaling those skids, or if the core business slows down, the bear case, the target drops to 270 rupees, a 40% downside. That gives us a really unfavorable risk-reward ratio of about 1.2 to 1. In stress-free investing, we generally want to wait for a pitch that gives us much better upside asymmetry.
Section 6. Final Investment Verdict. Wait for the pitch. All right, let's tie all these threads together into our scorecard. Business quality, solid green. Growth prospects with AI, green. Financial health with zero debt, green. But valuation, flashing red. The overall score comes in at 72 out of 100, which lands it firmly in our watch or hold category. It's an objectively excellent company, but for new money, the current market price simply carries way too much execution risk. So the analysis strongly suggests exercising some patience. A target entry price in the range of 280 to 320 rupees would change the math completely. If the stock corrects to that level, the risk-reward ratio improves dramatically to a much safer 3 to 1. Great investors know that sometimes the absolute best action is simply waiting for the right pitch. Before we wrap up, a quick but important disclaimer. The analysis shared in this explainer is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next explainer. Thank you for watching, and keep your investing stress-free investing.